So I'm Nicholas again from Capital Inc. I'd like to welcome you all to this session. Shipping is a capital-intensive industry, and access to capital is of critical importance for private and public shipping companies. So this panel will discuss alternative finance and private equity as capital providers to the industry. It's a key topic. We have with us five very senior expert professionals on the topic, and I will turn it over to Josh to moderate it. I simply wanted to say to all of you, thank you for being with us and for making this event and this panel a great success. And with this, Josh, please take over.
Thank you, Nicholas. First and foremost, wanted to thank you and your team for the opportunity to host this panel and for all your hard work in coordinating this esteemed panel. My name is Josh Apfelroth. I'm a partner at the law firm of Cadwalader, Wickersham, and Taft, based in New York City. We represent a number of shipping companies across the range of subsectors and across a range of corporate and transactional matters, ranging from mergers and acquisitions, corporate governance matters, securities and finance, workouts, restructurings, and the like. You know, I'm used to, or I've had the pleasure of hosting these panels in the last 2 years, each of the last 2 years in London, in some of the most extraordinary venues that I've actually spoken in. I'm here in slightly more humble confines than an attic in suburban New York City, but that doesn't diminish what I view as an equally distinguished panel of experts on the topic of alternative finance and private equity. Let me just start by introducing the panelists. First, Nicolas Duran of Fearnley Securities, Andy Dacey of JP Morgan Asset Management, Michael Kirk at RMK Securities, Paulo Almeida of Tufton Oceanic, and Richard Jansen of Braemar. I'd like to start, rather than my introducing each of you and your background, I'd like to start by giving each of you an opportunity to describe your background, describe your firms and your institutions' relevant experience and offerings. And then, in order to maybe shape our discussion and direct the discussion, an opportunity for each of you to discuss, briefly at a high level, what you view as the first and foremost issue or trend within your business that you're seeing today in light of current circumstances, whether it be COVID, environmental issues, or the like, and then we can delve deeper into each individual topic. So Nicholas, if you wouldn't mind starting, as you're the first on my screen clockwise, I'd appreciate it. Thank you.
Yeah, sure. Thank you very much. So I had the asset-backed financing team at Fearnley Securities. I'm a partner of the firm. I've been here for 5 years. I worked for a ship owner called Stena before that for a few years, and before that another stint at Fearnley. We primarily focus on financing companies in the maritime and energy sector. We're well, by global standards, a small investment bank. We have offices in New York and Oslo and around 90 employees. However, we have raised, around $11 billion of capital to the maritime industry alone in the last 4 years. So, I think we don't do telecoms, we don't do retail, we don't do fintech, but we do maritime, we do energy, and that's kind of where we focus. I think what we've seen from being a traditional investment banking firm, where we've relied on capital markets transactions a lot in the past, both equity and debt, the focus has shifted more towards what we here call alternative finance. As someone said before the call started, alternative finance is actually becoming mainstream finance to some extent. So that's kind of where we see it. I don't know if you wanted me to continue on the second part of your question or just pass it on to to Adrian for an intro.
Yeah, we could pass it on and we'll get into the specific topics.
Sure, Andy.
Great. Thanks, Nicholas. Thanks, Josh. My name's Andy Dacey. I run the transportation group at JP Morgan. We've been doing this for the last 10 years or so in terms of investing in the maritime and transportation industry. What we do, I guess, is a little bit different. We raise capital, we manage capital for mostly institutional investors. We invest that capital in different types of transportation assets. Ships are one of them. We've been raising different types of pools of capital to focus on different parts of the industry over time, and certainly have included everything from asset play, I think as one might categorize it, to longer term, more income generating deployment of capital. So a real mixture. I do think that some of the constraints that we've seen in the capital raising industry within shipping specifically have only become tighter over the last couple of years. And I think the search for capital is going to be one of perhaps defining themes going into the next 5 years for this industry as we confront all these other issues that we're talking about, whether it be ESG or fuel transition and things of that nature. But we manage about $3.5 billion of equity in the industry and have assets that are levered as well. That's pretty much it.
Thank you. Richard, on to you.
Yeah, thank you very much, Josh. Richard Jansen, I'm a partner at Braemar Naves Corporate Finance. I've been here for about 4 years now. Before that, I was global co-head at Deutsche Bank, of transportation, I should say. And before that, a long stint at DVB Bank in various locations. So all in all, about 20 years in maritime investment banking. At Braemar Naves, we focus predominantly on restructurings and capital raisings, as well as helping lots of hedge funds with loan portfolios that they buy from various shipping banks. So our forte is, or focus is particularly on the private capital markets, not the public, like for Nicholas. And yeah, we've raised a few $1 billion over the last few years in that space as well. And what I can say is it certainly hasn't become easier, although the money is still there. It's just definitely a lot more competitive these days, particularly post-COVID-19, for maritime firms to get their hands on that all needed capital. I think the challenge is there nowadays. I'll hand it over to the rest of my colleagues.
Great. Michael?
Sure. Hi. Mike Kirk, RMK Capital. RMK is an investment bank focused solely on maritime. So we've got offices in New York and London, and really focused kind of throughout the capital structure, everything from first lien debt and leases, all the way through to common equity. What we do is typically capital raising, and usually these are private placements with funds like some of the guys on the panel here, as well as hedge funds, private equity funds, credit funds, other people that are looking at the space. We've recently launched Ascension Finance, which is a direct lending platform in the space. This is for smaller owners, where some of the banks have retrenched from the market. So we're able to do deals, even sub $10 million now, kind of the $10 to $25 million sweet spot is where we're targeting for Ascension.
Great, thanks. And Paulo, if you don't mind.
Paulo Almeida. I'm the Chief Investment Officer at Taft Investment Management. We're a shipping-focused investment manager. We have about $1.2 billion under management. Most of that is in 3 private funds that we've been running for the past 5 to 7 years. And a couple of years ago, we raised a London-listed fund called Taft and Oceanic Assets, which is about $250 million market cap, that has 18 ships. In total, we have about 90 ships across all of those portfolios. What our main target is to give institutional investors exposure to shipping primarily on a cash flow oriented basis. So we generate low teens unlevered IRRs with diverse portfolios, and on average about 3-year charter coverage. We pivot those portfolios over time, and now and then either as a firm or with some friends or with other investors on a deal-by-deal basis, we occasionally buy into assets either as a firm or into corporates such as Hafnia Tankers, which we were associated with, and we were one of the co-founders of that business together with Blackstone.
Great. Well, thank you all. So let's just get started. A bunch of us, have mentioned the kind of breadth of the term alternative financing and the amorphous nature of it. Michael, maybe I'll start with you. Obviously the tightening of the more what we view as, some of us would view as the more traditional capital markets and lending resources has resulted in increased activity in what I guess some would call alternative financing, direct lending, private equity, structured products, and the like. How do you view these alternative financing sources a relationship to the more traditional financing sources? Do you view them as being in tension with each other, or are they more kind of complementary of each other? And with the alternative financing sources, filling a gap that otherwise would be left unfilled?
Yeah, I think I'd say certainly more complementary. Especially over the last couple of years, where the traditional financing sources, whether it's bank debt on one side of the equation or common equity on the other side of the equation, have just become more difficult, from the regular way channels like public equity as an example. So I think alternative financing's had to fill the gap. I think it probably started as a small sliver that was kind of playing in more interesting, funky situations, and I think now it's become extremely regular way. And for everything but really the top borrowers and maybe certain public companies, it's an avenue that really everyone should be looking at, and I think for the most part is looking at as a potential solution.
Got it. And Paulo, on the equity side, do you feel as though it's a similar relationship to traditional financing?
I'm not. Well, investing in ships is what in the investment world is definitely called an alternative investment. So very different from straight equities or straight bonds. We're investing in ships to give alternative exposure to investors where we can actually be considered financiers to the industry. We do have about 20%, maybe a bit less of our portfolio are actually sale leaseback deals. So, a lot of cases, particularly with older and often more specialized assets, where banks, mid-sized companies have lost some banking relationships, not because of the company's fault, but because some of the banks are just doing less. Banks are also focusing more on new builds, and therefore there's a gap in the capital structure where they need slightly more expensive credit, which we can offer on a sort of 5 to 7 year basis, but where we generally take the residual value risk. So that's the place where we play, and we like that space quite a lot, and it's something that our investors like a lot.
Got it. So you mentioned a couple things there. I think one is that traditional financing sources are still available. They're still out there. They're still active, and perhaps they're more active at the kind of larger company level. But this what we would view as alternative financing is more available to kind of mid-sized and smaller operators. Nicholas, how do you view that dichotomy as impacting the competitive landscape within the shipping industry? Does it kind of create more of a benefit or an advantage for larger shipping companies relative to their smaller counterparts, and how can kind of the smaller shipping companies or more mid-sized shipping companies bridge that gap?
That's a very interesting question. One would think that for a large part of the shipping industry, cost of capital is the most important factor or variable, and in that sense one would think that, you know, the tier one owners that have access to the cheapest debt are always going to win. At the same time, you know, this is a very strange industry where you have a US listed player with 100+ ships competing in a market with a Indonesian family owned shipping company that owns 3 ships and everything in between. And one would think that the larger player would always win, but at the same time, we've also seen that the cost for that, you know, the tier one type of companies of being in business, especially if they're private, it can also be high. So I would think that, you know, there are financing solutions out there for most companies in this industry, even for the smaller ones I just used as an example. You know, there's in fact, Indonesian company that we finance Aframax tankers for with Western capital. Yes, the capital was expensive, but they have low G&A and the ships were purchased at an extremely low price. So there's so many other factors in play there that I think mean that the interesting question is not whether you can survive with a higher cost of capital. I think it's more a question of, you know, that's more a question for whether companies, listed ones, for example, can stay listed, or whether this industry is going in a direction where it's all going to be about private capital and private solutions for everyone but a very, very, very select few.
And just as a follow-up to that, would you say there are areas where, you know, kind of alternative financing sources like yourselves bring more to the table, or provide kind of benefits, if you will, to your clients that, you know, potentially more traditional financing sources, you know, don't offer, around kind of expediency and expertise and otherwise?
Yeah, I think Paolo's point was quite good in that, you know, even for the, call it tier one owners, there are parts of their vessel portfolio, of their fleet, that are not financeable from traditional lenders. You know, if you're a dry cargo owner and you want to refinance a single 10-year-old asset, you are going to struggle a bit. You're not going to get Nordea's and SEB's and Danske's attention on that. They all want to finance the, you know, future new building program of dual fuel vessels, rather than that older asset. And that means that, you know, large companies like that, you can take Starbulk as an example, who's someone we've done a number of financings for. They've been very active in the leasing space because they've seen that the ability to optimize your capital structure and source of funding by matching the best source of capital for specific assets and specific projects gets you out on top and gives you an advantage.
Josh, if I may, I think that to second what Nicolas is saying, I think if you look at the last 10 years, there's been quite a big shift in funding sources for shipping, right? A decade ago, it was traditional senior lenders plus probably the equity capital markets. Obviously, we had a few downturns and a few bumps in the road since then. So I think the landscape has changed in terms of that people repositioned or institutions repositioned. Some obviously have left the space, but others have stepped in, or private equity become a little bit smarter and said, well, maybe we shouldn't be supporting everything with equity, but maybe a bit more from a credit angle. So I think the landscape is still as wide as it was before. It's, however, now much more bifurcated and much more specific with regards to, you know, types of capital and exactly what they're looking for. So nowadays, as a ship owner, you're having to spend a lot more time and actually pinpointing the right pocket of money for your particular need, whereas before you really sort of had to ring up your few banking relationships and they could cover a much broader range, and that isn't the case anymore.
Yeah. Well, Richard, that's quite interesting, and kind of gets to a follow-up question I had, so maybe you can address this as well. Have you found that with the entry of, you know, additional market participants around kind of the alternative financing solution, that, you know, it's almost that that some of the disadvantages, for instance, higher, cost of capital and otherwise, are essentially self-correcting through competition among, alternative financing sources, or is it, over time, has that been the case, or has it kind of been stagnant?
That reminds me of what one of my former bosses used to say: every ship being built was financed in some way, shape, or form, whether it was equity or a combination of debt and equity. So if it was built, somebody paid for it, and therefore it must have been financed in some way, shape, or form. So I think so long as we keep building ships, there is capital available. So yes, then the answer is automatically the sources have changed, and the types and the risk assessments and the risk reward propositions. But overall, the availability of capital hasn't changed. As a matter of fact, we don't have, as if we go out on behalf of a client trying to raise money, it's not that we're finding that there isn't money enough. There's plenty enough sources. It's, however, a lot more difficult to find the right pockets. So, for example, alternative financiers, the Fleetscapes or the MAPs, Northern Shipping Funds of this world, for example, there's 24 of those. You can go to them, but if it's not the particular flavor of the month, or they've just done a bunch of things in tankers, they don't want to do another tanker deal. So it's a little bit more, there's a lot more soft factors that you have to take into account if you're going to raise capital these days, and that makes it a lot more challenging. We spend a lot of time there for talking and engaging with all these capital providers to know exactly where we need to go. And one thing that could fit today doesn't need to fit with the same fund tomorrow, even though it's effectively the same deals. So, and that I think is probably the challenge for most people. For a time, there was a little bit of a let up when the banks were retreating. The Chinese leasing houses were coming in, and they were, gung-ho and picked up a lot of large deals. To a degree, I think a bit of name lending to it. They are pretty full now on what they wanted to establish, and now have become a lot more discerning in terms of adding new credit. So that has slowed down. Senior lending banks, traditional banks, have pulled back. The gap hasn't been fully filled with the Chinese leasing houses. Therefore, alternative capital stepped into the void, which to me, for the most part, was private equity that came down the capital stack a little bit and was a little bit smarter in how they deployed the money. But overall, I think total capital in the industry remained pretty much the same.
Got it. Thank you. So that's a nice, I think, segue to the next question I had for Andy. Which so debt versus equity. So historically, equity was popular. A lot of companies went exited, sought liquidity from capital markets through IPOs. There was private equity that was available, for joint venture type arrangements where the private equity fund and then ship operator owner would fund equity and take out kind of a more traditional bank loan. It seems as though the trend has been towards at least third-party money coming in through in the form of debt. But Andy, seeing as you manage quite a bit of funds for third-party investors and it sounds like your fund is in it kind of almost every stage or every level of the capitalization structure. Can you just talk a little bit about how investors are thinking about, third-party investors are thinking about debt versus equity and kind of the pros and cons of each?
Sure, and I think you can make money in every part of the capital stack. It's just a matter of approach, and I would say also scale. In the sense we're almost the traditional ship owner that's lurking in this panel, if you will, in the sense that we have a pretty big balance sheet. We go to the traditional lenders for our debt capital. Because of the size of the balance sheet, our borrowing costs are relatively low, and that provides, I think, at least from a scale perspective, it really depends on what business you want to chase after, right? So having a big balance sheet, having scale allows you, and also the operational expertise that I think is critical to putting money to work in this business, understanding the asset, but not just at the end of its life, but also while you run it. And again, we run the assets along the way too. So it's not just a residual value calculation, which again, not to say that's good or bad, but putting all those factors together allow us to ultimately compete for RFPs, whether it be for an LNG project or some dual fuel type of undertaking, bigger ticket assets that tend to go on longer term charters, and access a lower cost of capital. So I think that scale maybe creates a bit of a bifurcation in the industry, right? We're probably not going to be pursuing the 15-year-old Aframax. That might be something that a smaller ship owner would be interested in. And certainly seeking out alternative sources of financing becomes a lot more relevant when you're smaller and you don't have access to the banks that you had in the past, which clearly is a theme of this panel. But the one thing that I think is always, I suppose, perplexed me, or not perplexed me, but I think it's the return challenge. And if you're starting to get sort of low teens debt returns in shipping, that might be possible if you can move in and out of an asset quickly, and maybe you're providing bridge financing to help somebody get an acquisition completed that they go and then refinance at a lower rate. But at least from where I sit, it's hard to see long-term opportunities to generate a 12, 13% debt return. I do think those are available on the equity side. And again, that's driven by the amount of leverage you take, of course. But I think the industry is changing, right? So I suppose over time, I think the question to ask is, will alternative capital be available in significant quantities and at attractive enough rates to allow that smaller ship owner to survive and prosper in the long term? Or when you start looking at alternative fuels and some of the challenges that presents from an investment perspective, then what does that say about the type of shipping company that we need for the future? And I don't say I have any answers, but these are the questions that we wrestle with on a daily basis.
Paulo, do you have anything to add on that? Again, from thinking about where does the equity come from for ship owners to the extent they're looking to expand or refinance ships, and relative to debt financing that's seemingly more available.
That really is a tough one in terms of where traditional ship owners get equity from. I see equity coming into the business more through new types of ship owners or investment platforms like Andy's, like mine at Tufton, where we are putting capital to work. We may have different capital structures, but it's underlying institutional capital. We tend to do smaller ticket vessels and use less leverage, I think, than JP Morgan does generally, but we have different client bases, and there's plenty of space in this industry for both of us and lots of others. Just as the real estate industry 30 years ago, say, was dominated in each city by a number of families, it's become very institutionalized. The underlying ownership of those assets has moved towards pension funds, mutual funds, etc. And I'm not saying that it's a certainty that will happen in shipping over the next 10 to 20 years. I think it's increasingly likely. And I think that actually, I will probably talk about COVID later, but I think what COVID has shown is that in certain types of economic crises, and I think it's fair to call the past 6 to 9 months an economic crisis, and it's not over yet, that shipping can actually perform a diverse portfolio in shipping. I mean, we saw some bad performers, we saw some good performers. Tankers performed extremely well, not purely due to COVID, but partly due to that. We've actually seen that shipping has performed, or at least our shipping portfolio, and anyone that has sensible leverage and charter coverage and has diversity as well, will have performed better than any aircraft leasing portfolio, at least one based on wide bodies, performed better than airports, performed better than most commercial real estate. And this may help put shipping, sort of back onto the investment map. And I know that that's something that we've tried to do as Tufton, and I think JP Morgan has also been successful at that. And there's plenty of room to for both of us to grow
Thanks. Mindful of time, and we'd be remiss, as Paolo mentioned, not to talk about the impact of COVID on the shipping finance landscape. Michael, maybe you can address, the question of, how has COVID-19 and its obvious consequences impacted the shipping finance landscape, and in particular, your business around direct lending?
Yeah, I mean, I think that ultimately these are assets that still need to be financed one way or another. So I don't know that it had or will have kind of any long-term impact on the financing markets. I think the biggest thing we saw was just, frankly, ship owners really having to focus on the blocking and tackling of their business. So whether that's getting crew on and off of ships, making sure cargoes can get into port, some of those things. And so I think there was a delay in financing that really kind of lasted from April through kind of towards the end of the summer. So we're seeing activity pick up in a big way as people kind of come back and are really looking now to maybe do some things that normally they would have looked at a few months ago. But I think ultimately, these ships need to move, these cargoes need to move, and financing needs to happen. So I don't really see a long-term impact on the financing market from COVID.
Got it. Have you seen, as far as borrowers go, have you seen a variation between how borrowers have, addressed the issues, that you mentioned around, operations and otherwise, and has that factored into any of your, underwriting or investment decisions, or, has the industry, generally, moved in tandem in adjusting to, operating in a COVID style world?
Yeah, I might turn it over to Andy or Paolo, because they probably dealt with some of that stuff firsthand.
Sure. Yeah, Andy, would you like to take that one?
Yeah, I mean, look, I think margins increased a little bit theoretically if you were actually doing a transaction during the last 6 months. I would say that there's been a slower pace of transactions. I think buyers and sellers have felt, at least in the shipping space, that there wasn't a lot of price transparency. There was certainly a lot of uncertainty that began at the beginning of the year back in March with China, or even earlier than that in February, and then that sort of shifted more west, of course, as we all know. But from a volume perspective, at least what we experienced was volumes were down. For the things that we did do, the banks, as I mentioned, were asking for wider margins. Now, base rates had gone down, which was attractive. So the all-in cost of financing had decreased. But there was a general sense of things were uncertain and there was risk attached to it. And I think that the people were trying to cushion that blow by pricing up a little bit. I think post-COVID, I think as Michael was saying, and I think as Paula was saying as well, shipping has done remarkably well during COVID for all the reasons that I think we're all familiar with. And had we been going through a similar crisis, I think with a bigger supply of vessels, perhaps in the order book coming into the market, we would have seen a much different picture. But the essential nature of all the goods moving around, I think, insulated us, at least in this crisis. And oddly enough, if you think about it from an institutional investor's perspective, the discorrelation that occurs and if you look historically as well, shipping actually has a negative correlation with many asset classes, which if you're building a portfolio and looking at an alternative investment, then putting something into shipping that is gonna go up when everything else goes down, or at least stay stable when other things go down is attractive. And I think perhaps, and maybe I'm shifting a little bit, but that's one of the attractions that institutional investors find in shipping. But scale is an issue, and shipping, Paolo's point about the real estate world, I think is really relevant. But what I always worry about is that shipping is not nearly as big as real estate, right? It's a much smaller industry from a total capital perspective. And if you add up all the ships in the world, we're probably still less than Apple's market cap these days. So there's always that fine balance, right? We don't want too much money, and we want the right kind of money to come in.
Got it. Thank you. So again, another hot topic in shipping finance, ESG. Richard, I know we'd spoken a little bit about this in our introductory call. Obviously large banks, traditional financing sources, regulators have all put a significant focus on environmental. We'll take the E part of ESG first and probably last, because we're running out of time. but they've all put a significant focus on the environmental aspects of their borrowers and operators, and they've made it clear that if you're not adhering to not just the regulatory standards, but also standards that they've promulgated through things like the Poseidon principles and just through their general underwriting checklists and criteria, that if you don't meet those standards, then you're unlikely to have access to those type of more traditional financing sources. And a lot of the larger operators have of course taken that and attempted and successfully attempted to adhere to those new rules of the road. How does that play into your investment decisions of what we're calling alternative financing sources, but we'll just call them kind of non-traditional financing sources? How does that play into your investment criteria relative to that of others?
Of course, it's important. It's an important development for the global economy, and I think shipping as an industry certainly is an industry that can play at the forefront of this development, can and should, quite frankly. And I think it's only commendable that there are that there are initiatives like the Poseidon Principles and others that try to accelerate this development. You see that there are indeed there is again this bifurcation, this more granularity of pockets of money that you can find. And yes, there is now this pocket, if you want to be a larger borrower with one of the mainstream corporate banks particularly, then an ESG element helps you get access, well, not actually get access, but actually to maintain access to that cheapest funding. Yeah. And so it goes with, it works on both ways. The ESG, positioning your business to take advantage of the benefits of ESG. On the one hand, obviously it's a cost in terms of renewing your fleet on that basis. But on the other hand, I think also to your off-takers, your customers as a shipping company, you can help them attain their ESG goals. So actually, if you think about it as a longer supply chain, you as a shipping company can support your industrial clients in their initiatives. And on the back end, you have your banks that can support you in actually attaining those goals. It's a win-win for the entire supply chain. What we do see, on the other hand, there's still enough pockets. The market is deep and wide enough that if you're not particularly able as a company, because you're a small company or just don't have the funds, or it's not necessary for your particular segment, this is not the end all. This is just about, can I get access to LIBOR 250 for a 60% financing on an 18-year profile, yeah, with some of the Nordic banks or the French banks, etc. That's where ESG principles are actually relevant. If you're talking much broader, the alternative market, there's plenty of other pockets to get the capital. It will be more expensive. It doesn't have to be all 12% plus, but it will be more expensive, harder to get, maybe smaller volumes, but there's still plenty of capital available.
Got it. And Nicholas, maybe we'll just, I think, end on you. What's in it for the financier? So are you, as a financier, looking to ESG as a way? How are you looking at it, I guess, is my real question. Is it to benefit, for the benefit of the greater good, or is it more kind of to be used as a criteria in understanding creditworthiness and making investment decisions? How are you thinking about it? I get, I understand why the big banks are carrying. The JP Morgans of the world have a much larger platform, but how are you thinking about the E part of ESG?
Well, I think that what we see is that it's primarily the largest institutions that have a lot of focus on that. And whether that is out of for altruistic reasons or because they're listed and they need to maintain you know, a certain responsibility and have accountability towards the greater public. That's one thing, but I don't really see a lot of the alternative financiers set the bar very high when it comes to the E part of ESG, apart from the obvious requirements with things like green scrapping, etc. And I think, you know, that's, you have the luxury of being a bit more flexible and vague if you are a small alternative lender than if you are Nordea, for example. And I think that's reflected, you know, someone needs to finance the 10-year-old ships of this world. Not everyone can be running after offshore wind, SOV, tender financings at less than L plus 200 basis points. You know, that's not the business for everyone. So I think you'll see that there is going to be a fairly broad range in the approach towards the E in ESG amongst lenders, whether it's traditional lenders or alternative ones.
Got it. Well, thank you so much. We're getting the wrap-up music in my ear right now. So you know, obviously we've only touched the tip of the iceberg. There's a lot to talk about here. It's a broad subject, but I wanted to thank our panelists for their tremendous insight and their time. It's been a really interesting conversation. And again, thank you so much for participating, and thank you to Capital Link. I was told to you know, ask anybody who had any questions or follow-up questions, and the panelists, to the extent they have time, to join the Capital Link networking lounge to address any follow-up questions from the audience. So if you can do that, great. If not, thank you so much again for your participation.
Thanks, Josh.
Thank you.
Thank you, everybody.
Thank you.
Thank you. Bye-bye.